The government raised the SALT deduction to $40,000 for tax years 2025 through 2029, which should save most retirees around $10,000 to $12,000 in taxes. But there is a hidden income trap. If your income crosses certain thresholds, that $40,000 cap phases right back down to $10,000. Losing that $30,000 deduction means you could be paying an extra $10,000 to $12,000 in taxes you didn't need to pay. Today I'm showing you 5 strategies to protect that full deduction, even if your income is high. Let's start with some foundational moves. These work well for moderate income situations, but if your income is consistently high, you'll need the more advanced strategies I'm covering after this. Number 1. Defer or split big income events. If you are planning on exercising stock options, taking a large bonus, or selling a second home, see if you can spread that income over multiple years. Be smart with sequencing. Try not to stack a Roth conversion and a large capital gain in the same year. Space them out to keep your income as level as possible over time. Number 3. Harvest losses. It's a classic for a reason. Using investment losses to offset gains can directly lower your modified adjusted gross income, which helps protect your SALT deduction. Number 4. Use qualified charitable distributions for your R&Ds. This is one of my favorite recommendations. If you're over 70 and a half, you can send money directly from your IRA to a charity. It satisfies your required minimum distribution but doesn't count as taxable income, so it helps keep your modified adjusted gross income low. And number 5. Max out retirement contributions. If you are still earning some income, funneling more into your 401k or other deferred comp plans is a straightforward way to reduce your current taxable income. Now, let me show you one of the most effective strategies for high income situations. The non-grantor trust. I know it sounds technical, but the idea is actually very simple. In plain English, this is a trust that's treated as its own taxpayer. It files its own return, it has its own standard deduction, and most importantly for us, it has its own SALT cap. Why does that matter? Well, if you personally can deduct up to $40,000 in state and local taxes, and your trust can also deduct up to $40,000, you've just doubled your family's capacity. Here's how it might look in practice. Let's say you have a vacation home with hefty property taxes. If you title that property in the name of a non-grantor trust, the trust pays those taxes and can potentially deduct them on its own return. The key is in the drafting. This only works if the trust is intentionally set up as a non-grantor trust. This isn't just opening a trust account at a bank. It requires very specific language in the trust document. A quick but important personal recommendation here. If you explore this, make sure your financial advisor, your CPA, and your estate planning attorney are all talking to each other. The drafting and administration are critical. You have to avoid certain grantor powers that would accidentally collapse the trust status back into your own tax return. Your advisor can be the quarterback here, connecting the dots between the tax strategy and the estate plan to make sure it all holds together. So, if one trust can be helpful, you might be wondering, well, what about 2? Or maybe 3? It's a natural question, and the answer is yes, you can potentially multiply the benefits. But this is where we need to lean in and be extra thoughtful. The idea is to create separate, legitimate trusts for different beneficiaries, like one for each of your children, because each one is considered its own taxpayer. Each one gets its own shot at that SALT deduction. Done correctly, you are essentially expanding the family's overall capacity to itemize. Now, here's the really important part. The IRS is wise to this concept. They have rules in place to prevent what they see as abuse, basically just creating clone trusts solely for a tax benefit. Each needs to have distinct beneficiaries and a real purpose to avoid anti-abuse rules. For example, one trust might be primarily for a grandchild's education, while another one is designed to support a charitable cause you care about. When each trust has its own unique purpose, it transforms the strategy from just saving on taxes into a thoughtful way to manage your legacy. You are building something that's both effective for your family and designed to last. Now, here's a strategy I particularly like when it aligns with your goals. It involves pairing your charitable giving with the trust itself. You see, a non-grantor trust can make charitable gifts, if the trust document is written to allow it, and deducts those gifts on its own tax return. Why is that a big deal? Because those charitable deductions can push the trust over its standard deduction threshold. Once the trust is itemizing, suddenly all those property taxes or state taxes it pays become deductible too. Let me give you a simple example. Imagine a trust has $25,000 in property taxes. If that's less than the trust standard deduction, those taxes aren't really helping you. But if the trust also makes a charitable gift, That combination can push it into itemizing territory, making every dollar of those property taxes count. A really smooth way to handle this is by having the trust-funded donor advised fund. It gives you a lot of flexibility on when you actually distribute the money to charities and makes the admin side of things much simpler for the trustee. It's a great way to make your philanthropy go even further. Another really impactful move, especially if you have income from a business, a rental property, or even a family investment partnership, is something called the pass-through entity tax, or PTET. Here's how it works. Many states now allow S-corps and partnerships to elect to pay state income tax at the business level. The power of that move is that it turns that state tax into a business expense, deductible on the entity's return, which means it completely bypasses the SALT cap on your personal return. Think of it as shifting that deduction off your Schedule A entirely and escaping the limitation altogether. It's a really powerful workaround. Now, the catch, and it's an important one, is that every state's PTET rules are different. This strategy emerged after the TCJA created the $10,000 SALT cap in 2018. Since that cap was originally scheduled to expire after 2025, many states designed their PTET rules as a temporary workaround. Now that the federal cap has been extended, the landscape is evolving. Some states have made their PTET elections permanent, while others are still deciding. That's why it's absolutely critical to check your specific state's current rules and sit down with your advisor or CPA to run the projections for your specific situation before making the election. But when it aligns with your state's rule and your income, it's one of the cleanest and most effective ways to manage around the SALT cap. Now, let's look at a little-known timing rule that offers a great deal of flexibility. It applies to what's called a complex trust. Simply a trust that can accumulate income rather than being required to distribute it all each year. For these trusts, there is the 65-day rule. It lets the trustee treat any income distributed in the first 65 days of the new year as if it were paid in the prior year. Why is that so helpful? It gives you a rare chance to fine-tune after the year ends. You can look at the final numbers and decide, should the trust keep the income and use its sole deduction or distribute it to a beneficiary in a lower bracket? But here's the important part. The 65-day rule doesn't stand alone. It works best when it's coordinated with your other income sources, strategically spreading out income events so they don't stack together. Take required minimum distributions, for example. At 73, or when managing an inherited IRA with a 10-year withdrawal rule, you may face large, unavoidable taxable distributions. If that coincides with a Roth conversion or a capital gain, the effect is magnified, which is why timing becomes critical. When you think of these moving pieces, the timing rules, unavoidable distributions, and your discretionary choices as one interconnected puzzle, that's how you build a tax plan that's both resilient and efficient. So how do you match these strategies to your life? Think of it less as a checklist and more as a menu. Trust route. Best if you have significant property or state taxes and want legacy or asset protection. Separate trusts. Useful if you have distinct beneficiaries with different planning goals. Charitable giving at the trust level. Boosts SALT deductions through philanthropy. Pass-through entity tax election. Top choice if you have pass-through income and your state offers it. 65-day rule. For trust level fine-tuning after the year ends. And number 6, R&D coordination. Essential for anyone nearing 73 or managing inherited IRAs. But from my personal experience, the best results often come from combining these strategies, not just relying on one. Before we wrap this up, I want to be clear about what's on the line here. If this planning feels too complex, the cost is real. Without a plan, you risk leaving tens of thousands of dollars in deductions on the table, money that could have stayed in your pocket. But with the right strategy, you can align your income, trusts, and charitable giving with your bigger goals. And this is where having a financial advisor makes a real difference. Not to sell you anything, but because these strategies don't live in isolation. A good advisor can model the trade-offs, coordinate with your attorney and CPA, and make sure what you do today still supports your long-term vision. Think of it like playing chess, not checkers. Every move has ripple effects, and the goal is long-term success. And before I finish, there is one more important point. Even if you soften the SALT torpedo and win this battle, many retirees discover their overall tax rate never really drops in retirement. It's a common surprise, and if you want to understand why that happens and how to plan for it, check out this video. Thanks for your time. I hope this was useful.